Welcome back. Today I have an exciting video for you. Throughout this video, we will be going bull versus bear against Everything Money, debunking their Palantir essentially bear case in what they presented in a video a few weeks ago, and I will be sharing my analysis. And I actually purchased their Everything Money software to get an idea of how it works, what they're looking for as value investors, observing growth stocks. So I think this is going to be a great video in terms of what you can expect for Palantir 10 years out, because this is going to be a 10-year forecast and what the stock can do on the low end or on the high end. So without further ado, let's get started. But I want to thank once again Masterworks for sponsoring this video. Let's go. All right, so here we are. I have parlayed Everything Money's analysis in their low, so their bear case, their mid base case, and their high bull case for Palantir. Once again, this is 10 years worth of analysis for a DCF, and they're expecting on the low end, very conservative 15% growth for those 10 years, and on the middle, 25% growth. Remember, Palantir themselves are guiding for 30% growth. So to come in under that, I'm not really sure that's a fair base case. But anyway, their bull case is a bit higher than what Palantir's guidance is. So you'll see those actually translate to only 4 times revenue in their bear case, which is pretty ridiculous considering Palantir is going to blow that away in 2025 or 2026, any way you want to look at it, not 2032, all right, 2032. And here we have 9 times revenue for their base case and 20 times revenue for their high case. Now, recall that Alex Karp said there's no reason this company can't be 20 times larger.
We've gone from a company, we crossed the $1 billion GAAP revenue market. There is no reason this company should not be 20 times bigger.
I'll be coming back to that in a moment. Then they basically bring in some very, very conservative profit margins. We know Palantir isn't bringing in profits today, and for that reason, Everything Money is forecasting a very conservative, very low profit margin, because they're going to have, Palantir's going to have negative losses. Gains in the future need to offset. So they're coming in pretty conservative on the profit margins here, and then go ahead with what I would consider a laughable price to earnings metric for these 3 cases. And why is it laughable? Well, if you're growing 35% through the end of 2031 and your price to earnings ratio is only 17, that is a PEG, meaning price to earnings growth, so PEG, of half, basically. So why? Well, that's just not the case. That's not what software businesses do. That's not how you value a growth company. Their price to earnings ratio is not going to be half of their growth rate, especially if they keep up that growth rate through the end of the decade and even further. They're wrong about that, in my opinion. Of course, the market can do whatever it wants to do. A very low price to earnings ratio as far as I am concerned. And I think that comes from their approach. I have nothing against Everything Money. They can totally do whatever sort of analysis they want. Again, they're value investors. They said themselves they haven't made any money in the last 5 years in this bull market. They think everything is overpriced. And you see that in their analysis of price to earnings ratios. They think everything's inflated. It has to come down. It's going to come down, and they're not going to give out multiples that we see in today's market. So I think that's a big flaw. Take that into consideration. But then they bring out a 15% annualized return, which is the discount rate for their DCF. This is, once again, what they are choosing to use, which means they're discounting much higher than the typical, I'd say, 10% discount rate or so. So that lowers the price target. You'll see a few things building up to lower the price target, but then we get to their stock price projections based on the DCF, based on these numbers above. So for the low case, I mean, there's no sugarcoating it. If Palantir does not grow at its projected rates, if it plummets to half of those rates, the company is not worth what it is trading for today. That's plain and simple. If you don't think Palantir can grow like they say they will grow or exceed that, do not invest in the stock. That is just my opinion. And again, of course, there are many different things you can use to manipulate a DCF. My opinion is that this is a very low possibility of happening for the next however long, 10 years or whatever, really. So that would represent a $2 billion market cap, not something I'm looking at. Now, on their mid case, this brings their 25% growth, missing guidance for the next 10 years, which again, I really don't see that happening. And that would bring the price down to $3 per share. So this is in their very, very conservative case. They essentially say with 35% revenue growth, more or less in line with expectations, we think Palantir is worth a little less than what it's trading for today. Today it's around $13 or so. With Palantir trading at $13 and them willing to pay $10, that's essentially saying this is the most we'd be willing to pay. Let's extrapolate that out. I think this is very interesting for all investors to see. We're coming in with very conservative profit margins, and of course the PE that I mentioned, very, very conservative, and the annual return. This would be 15% return year on year. So that would actually bring them to a market cap in 2032 of $82 billion and a stock price of 40. So everything money is essentially saying Palantir will not ever reach an all-time high again until 2040 or into next decade, all right? That is a little ridiculous. Now, let me share with you what I am thinking. But first, I'd like to recognize today's sponsor. Today, investors face a dilemma. Inflation is at a 40-year high. The Fed is tightening up, and top firms predict stock market returns under 5% for the next decade. As a result, a recent JP Morgan report declared alternative assets are no longer optional. And of all the platforms for alternative investing, there's one that's a no-brainer. It's called Masterworks. Masterworks has solidified itself as the platform for investing in contemporary art. You can find exclusive investments from names like Banksy and Picasso for just a fraction of what billionaires pay, because roughly 2/3 of billionaires allocate portions of their overall portfolio to art as a way to diversify, and because it's a natural inflation hedge. Since 2020, Masterworks has sold 3 paintings, with each returning over 30% net IRR to investors, and their new offerings usually sell out in hours. 30+%. That's wild. If you want to get in early, go to masterworks.io, create an account, check out what they have, and invest in their offerings. And as subscribers, you get to skip the waitlist using the special link in my description. Okay, so here we are with my analysis. On the low end, again, this is not going to turn into anything. If Palantir is not able to keep up their growth at the current valuation, this stock is really not going to be worth it. In fact, it's probably going to lose everyone involved a lot of money. But I would rank this possibility very low in what I would expect in terms of probabilities. 20 times revenue would mean they would actually only grow revenue by 6 times in those 10 years, and 30% compound annual growth rate, 32%, is 16 times. And then 37, this is my ultimate high-end case, would be 37% revenue growth, which would be 23 times revenue. Now, bringing it back to this idea of the 20 times, Karp said there's no reason this company can't be 20 times larger. Well, do you believe him on that? I certainly do. With Palantir doing $1.5 billion in the last trailing 12 months in terms of revenue, we can see if we just do $1.5 billion in revenue times that 23 times higher of that compound annual growth, we're getting 34 to 35 billion in revenue in the next 10 years. That's not out of the realm of possibility. Now, a lot has to go right for that to happen, but that is my bull case, okay? As I've been saying more recently, require a significant breakout in terms of the actual growth rate. So Palantir can't just do 30%, 35%, 40%. I think later on in the next few years, they're really going to have to ramp it up even more. And I think some of the tailwinds are going to come into play with the government growth picking back up again. I think that's a real tailwind, as I've said in the last couple of videos, but also commercially. I think once Palantir continues to get a hold in the commercial market, we are really going to see that pick up. That's just my opinion. This is not financial advice, but I do not think that 23 times is out of the question, especially since Karp has gone outright and mentioned, listen to him here, he's gone outright and mentioned how Palantir do 20 times more deals, 20 times more revenue. It's not entirely clear what exactly that 20 times number is referring to, but I do think it's something that's within the realm of possibility in the Ultra Bull case for Palantir, which I've outlined here. And then in terms of profit margin, I only increased these slightly. If you look, Everything Money had actually used a profit margin of 4, 8, and 12%. I raised this to 5, 10, and 15%. It's really tough with Palantir because they are not profitable yet, so you really don't know what that's going to turn into eventually. It really is anyone's guess because throughout the decade, plus those next 2 years, it's going to be losses before that point until they turn profitable. So it's some really speculative calculations in terms of the profit margin. I'm just going to leave those there because I think they were being a little too conservative, but you can play around with that if you want to. Now, in terms of the price to earnings ratio, so I just put a tiny a really low price to earnings ratio of 10 on the low case, which is just absolutely ridiculous, especially for a company growing 20%, which I do not believe they will be. But in the base case here, let me just rename these bear, base, and bull. So here we have the base case. I think a price to earnings ratio of 27 price to earnings. I don't think that's absolutely ridiculous when the company is doing 32% in terms of growth. If we look at the price to earnings growth ratio, which is PEG, which is price to earnings divided by your percentage growth, that would be a less than 1. We do Palantir's earnings, which is 27, and we divide it by their growth, which is 32, okay? 32. That puts us at less than 1. A general rule of thumb is that you'd expect a price to earnings growth ratio of around 1, okay? And above 1 is definitely what you see in today's market with a lot of companies. So to see it even below that, I really think is a base case. Now, in terms of the bull case, this is where I'm really ramping it up. This is where you'll see the change in the numbers. I've increased the PE ratio up to 35. And again, that puts it below the growth rate. So this is going to be a lower than 1 PEG ratio. Now, I do think 35 is getting there. I think it's increasing a little bit. So I don't think you can go much past that for 37% growth, especially since Palantir will likely be hitting the top to middle half of their S-curve, whereby they won't be increasing revenue substantially beyond that point. So I think the price to earnings ratio will start to compress there if it has not already started to. But what I'm saying is increasing the price to earnings ratio to a place where it should be more than what everything money forecasted it to has a tremendous effect on the price of the stock. So I'm going to go ahead and reveal my numbers. So this is what I'm expecting. Once again, it doesn't change anything on the low end. If Palantir only delivers 20% revenue growth at the current valuation, using, of course, the DCF, where you can really get lost a lot in terms of the DCF because it has a lot of factors that it's neglecting, especially this is Everything Money's stock analyzer format that they were using, that I use, that I paid for to be able to understand the way they're looking at things. Anyway, I think this is an oversimplified way of looking at it. Really, a DCF says this is the minimum that should happen at a given scenario. So it's generally going to be higher than that unless something catastrophic happens. So it's actually not dollar signs here. These would be billions of dollars just to differentiate that. $4 billion market cap on the low end. Again, I think that's a little ridiculous, but you got to put in a bear case somewhere. And then on the base case, this is where it gets interesting because that's actually above today's price. So I think as a base case, Palantir is undervalued. That's just my opinion. I'm not telling you if that's right or not because I don't know. But what I'm saying is if they're able to grow revenues 16 times and their revenue growth to that end is 32% and the profit margin 10%, price to earnings of 27, annual return of 10%, we get to a price where Palantir is undervalued in today's pricing. But then we get to the bull case, which again, this is going to be very tough to achieve. I do not think it is guaranteed. I think this is what you're looking for. If you're looking for a multi-bagger on Palantir, you're looking for these kinds of numbers out of the stock, which is fairly in line with the management is saying for the long term. It's just a matter of how soon is it going to happen. So we have 23 times revenue, 37% growth, 15% profit margin, 35% price to earnings, and we get $41 the stock is worth today. Today, the stock is worth $41. If these metrics happen in the future, that's what the stock is worth today. And it is an $83 billion stock. However, these are not guaranteed, so that's what the risk is with the 10% discount rate. So I'm going to go ahead and reveal my predictions based on that. I'm not saying these are my actual price predictions. I'm saying these are the predictions based upon what we just generated with Everything Money stock analyzer tool, based on what they have done, based on what I paid for and was able to learn through my own research. Okay, so we have the stock price today of $41. That's what these metrics make Palantir worth today. Now, you may disagree with them. I encourage you to disagree with them because they are not all going to be correct. We add 10% to the stock every year. That brings the stock to $106 10 years from now, 2032. There's a kicker, though. I'll tell you what that kicker is, but I just want to mention that that would bring the market cap to $216 billion, all right? Everything Money, they plug in their numbers to their tool of the stock analyzer tool, and they say Palantir is worth $10 today. And that's on their high end, too. Well, I think they're drastically wrong on that. It's just my opinion. I think Palantir will perform much better. Just my opinion. That's what I'm investing for. They are maybe short Palantir. I don't know. I don't think they're short, but anyway, they have a negative view of it. They've been very right over the past year. I'll give them that in terms of the direction of the stock. So they got the short term right. Let's see what happens over the long term. I'm expecting Palantir to do much, much better in the bull case. I think there's some glaring mistakes in terms of their analysis, but that's just where they're coming from, the perspective of value investing and the real true intrinsic value versus not wanting to pay for growth is basically their mindset. Okay, so anyway, what I was getting to down here is if Palantir is $216 billion in market cap, let's just write this out. We'll bring down another column here. We'll say $216 billion in market cap. Guess what we can do with that? We can get the price to sales ratio. And guess what you can do with the price to sales ratio? Well, once we have it calculated, it's going to be the market cap divided by the revenues. This is for the year 2032. That's a price to sales ratio of 6. This is the bull case, and Palantir's at a price to sales ratio of 6. That is crazy for a company growing, from what I'm forecasting, at 37%. Okay, for them to have a price to sales ratio of 6, that easily justifies probably 2 times higher, to be honest. So I think that might be even drastically very low. If Palantir hits all those numbers, I think their price to sales ratio should be well in excess of 6, maybe double, maybe triple. So I'd say 2.5. So I'd say perhaps my price target is not 106. It's actually 266, okay? Because I think that price to sales ratio is too low. Now, many people will say the price to sales ratio, that would be too high for a more mature company once they're getting to that end of the S curve. So maybe you're right. I'll knock it down to $213 basically, and I'll agree with you there. So I think that's the real lesson here is Everything Money and anyone that does DCFs. This is a very glorified, simplified DCF. I was not able to show their website exactly, and I actually just made my own analysis basically based on what I learned from their tool. But what I'm saying is they wouldn't let me share it. It's very clear in their terms and conditions. You cannot share this. You cannot share our website. These are trade secrets or whatever. So I totally respect that. It's kind of restricting. But anyway, that's why I made my own here. And that's why we're just going off the DCF, not other multiples or anything like that. What I'm getting at is if you look at that analysis, it's very limiting. There are some major mistakes in terms of the growth of a company, certain DCFs and certain ways of observing a stock into the future don't work well for growth companies. Now, that's not the person's fault really. If they're just unsure or uneducated on the future of a company, it's easy to get stuff like that wrong, okay? So again, nothing against Everything Money, not trying to start anything with them. This video was just to share my thoughts and opinions on simply the revenue growth, profit margin, price to earnings, and annual return, and what you get with a stock price from that, which I believe is what I've been saying really since the beginning of this channel is Palantir could potentially be a multi-$100 billion stock. Multi-$100 stock. Could be totally wrong. That is in my bull case, okay? Let's be clear, that's in my bull case. This analysis, I'll tell you, has made me much more aware of the bear case. I was not so sure about what the bear case could do to the stock. Demonstrates the risk if Palantir fails to perform. And they're working as hard as they can. A lot of the factors are out of their control. It's a matter of how do the dynamics adjust commercially in the government sector, stuff like that. And that's why this is a bet here. Not necessarily a bet, it's this upper option, this 15 times 15 bagger, this 10 to 15 to 20 bagger is not guaranteed. It's what you get on the high end. In this base case though, this base case is fairly attractive. We've seen Palantir stock get slammed. It's down so much, and that's just on a relative basis basically, but you can't really ignore that. And I think brighter days are ahead for Palantir. There are other places you can go. Of course, you can invest in other stocks and other assets like I was talking about with Masterworks, anything like that, whatever works for you. I'm just sharing my analysis, and I hope you do your own research as well. Let me know what you think in the comments, and please leave a like since I did spend my own money to buy the Everything Money software for this video research. Thank you, and until next time.